What if the only thing holding your money back isn't the stock market, but the way you're approaching it? And what if the rules you were never taught are the reason investing still feels confusing or intimidating? Most beginners don't fail because the market is too complex. They fail because they enter it without a roadmap. And with 2026 bringing uncertainty, shifting rates, and rapid change, these rules aren't optional anymore. Learn them now, and you'll invest with calm, clarity, and confidence instead of fear. A few years ago, someone I knew entered the stock market the same way most beginners do, with excitement, hope, and absolutely no structure. They copied trends they saw online, bought companies they barely understood, checked their phone 15 times a day, and panicked every time the market breathed in the wrong direction. When prices dipped, they sold. When prices rose, they felt brilliant. And eventually, exhausted and embarrassed, they told me, "I guess investing just isn't for me." But here's the gentle truth they never realized. The problem wasn't investing. The problem was investing without rules, without a map, without a calm system guiding their decisions. Their mind was the battlefield, not the market. And you deserve a much better starting point than that. What if the stock market isn't confusing at all, just misunderstood? And what if the real reason beginners struggle has nothing to do with intelligence and everything to do with missing structure? The market isn't a lottery ticket, it's a system, and systems reward clarity. Most beginners fail not because they're incapable, but because they're drowning in noise, hype, and pressure to predict the future. Prediction is weak. Structure is strong. Today's 12 rules will guide you through 2026 and beyond with calm and confidence. Before we begin with the rule almost nobody talks about, make sure you're subscribed. This channel is built to bring clarity and emotional stability to your financial life. Here's a simple question that every beginner should ask before buying anything. Am I investing intentionally, or am I reacting emotionally? Most beginners don't invest, they chase. They hear a friend mention a hot stock, see a headline online, or feel a surge of motivation and jump into the market without a structure guiding them. The irony is that they believe they're making decisions, when in reality the market is making decisions for them. A real plan answers the only three things that matter: why you're investing, how long you're willing to stay invested, and how much risk your emotions can genuinely handle without falling apart. Predictions create anxiety because they rely on guessing. Plans create wealth because they rely on clarity. When your plan becomes your anchor, every decision becomes calmer, clearer, and unbelievably simpler. And once your plan is grounded, the next rule that protects you from the silent trap that destroys most beginner portfolios before they even grow is automate your contributions. Most beginners invest only when they feel like it, and that feeling disappears the moment life gets stressful, complicated, or uncertain. That's why automation is one of the greatest wealth-building tools available to real adults today. When you automate your contributions, whether it's $50 a week or $200 a month, you remove emotion entirely from the process. You stop negotiating with yourself. You stop hesitating. Your investments grow quietly in the background while you live your life. The answer is simple. Automation turns inconsistency into momentum. It makes wealth building a habit instead of a heroic effort you attempt only when inspiration strikes. But automatic investing only works if you understand one truth most beginners overlook. Your time horizon dictates everything. Before investing a single dollar, ask yourself this: when will I realistically need this money back? Most beginners skip this question, and it's the reason they panic when the market dips. If your timeline is short, like 1 to 2 years, the stock market becomes dangerous because volatility doesn't give you enough time to recover. But if your timeline stretches 5, 10, or 20 years into the future, volatility transforms from a threat into a gift. The longer you stay invested, the more time works in your favor, smoothing out the turbulence and multiplying your results. Simply put, your time horizon determines your level of risk, your peace of mind, and the type of assets you should choose. When you respect time, the market becomes far less intimidating. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. Moving forward, once you understand your timeline, the next rule simplifies your entire portfolio and removes one of the biggest sources of beginner confusion. Here's a question most beginners never ask themselves. Is my portfolio growing, or is it just getting crowded? A lot of new investors confuse activity with progress. They buy 10 different stocks, sprinkle in 7 ETFs, add a little crypto just in case, and assume that having more equals being safer or smarter. But in reality, complexity becomes noise. It spreads your attention thin, weakens your decision-making, and makes it harder to understand what's actually working. Wealth grows faster with simplicity because simplicity keeps you focused. 3 to 5 core positions are more than enough for most beginners. Clear, balanced, and easy to maintain. A simple portfolio doesn't limit your potential. It amplifies it by removing confusion and giving your money room to breathe and grow. And speaking of clarity, the next rule protects you from one of the most expensive mistakes beginners make. A mistake fueled not by strategy, but by excitement. Another question worth asking: if everyone is already talking about a stock, what advantage do you realistically have? When something becomes a trend, beginners feel drawn to it because it seems like a shortcut. Fast profits, easy wins, guaranteed upside. But trends are emotional, not logical. By the time a stock goes viral, the people who benefit most have already positioned themselves long before you heard about it. Getting in late traps beginners into buying high and selling low once the trend fades. The answer is simple. Chasing what's popular is gambling disguised as investing. Real investing is boring, steady, predictable, and that's exactly why it works. When you stop chasing excitement, you finally start building wealth. And now that we've protected your portfolio from hype, let's protect it from an even more common mistake: investing money you'll need too soon. Ask yourself this: if an emergency happened tomorrow, would I be forced to sell my investments just to stay afloat? Many beginners unknowingly set themselves up for panic because they invest money meant for rent, bills, or short-term needs. And when life inevitably happens, a car repair, a medical bill, a job change, they're forced to pull money out of the market at exactly the wrong time. Short-term money should never be in long-term assets. The answer is simple. Investing is not just about growth, it's about timing, and using tomorrow's money today is the fastest way to sabotage your future. The market rewards patience, not desperation. This is also why having clarity matters. If you want an honest, grounded way to see your income, spending, assets, and safety nets clearly, the Trip to Wealth Command Center is designed for exactly that. You can join the early access list below if you'd like to be one of the first to use it. And once your short-term life is protected, the next rule shows you how to protect your portfolio itself, with the kind of risk management that separates beginners from real investors. Here's a question every beginner should answer honestly. If one of your investments dropped 40% tomorrow, would you stay calm or would you collapse? Most beginners don't fail because they choose the wrong stocks. They fail because they invest the wrong amounts into them. Without risk management, every decision feels like a gamble. With it, every decision becomes measured and intentional. Basic risk management simply means protecting yourself from yourself. Never put too much money into a single stock, don't make choices based on fear or excitement, and balance your portfolio between safety and growth. The answer is simple. Risk management doesn't limit your upside. It protects your foundation so your upside can actually matter. A good rule of thumb is that no single stock should ever be more than 10% of your portfolio as a beginner. And once your risk is under control, the next rule simplifies your entire portfolio by focusing on what actually drives long-term success. Here's a powerful question most beginners overlook. If professionals struggle to beat the market, why do beginners believe they can? The truth is humbling. Even seasoned investors rarely outperform the market consistently. That's why index funds and ETFs are the backbone of most long-term portfolios. They give you instant diversification, lower risk, and the ability to grow with the entire market instead of trying to outsmart it. For beginners, this is a gift. You don't need to pick the next big winner, you just need to participate in the growth already happening. The answer is simple. ETFs reduce complexity, minimize mistakes, and let compound interest do the heavy lifting. Stocks are optional. Broad, diversified funds are essential. But even with a strong core portfolio, there's one habit that quietly sabotages beginners every single day. And fixing it changes everything. Let's talk about how often you check your investments. Here's a question most beginners have never asked themselves. Is checking your stocks every day making you a better investor or a more anxious one? Daily price movements are noise, red, green, a roller coaster designed to trigger emotion, not clarity. Beginners who check constantly end up making fear-based decisions, chasing temporary feelings instead of long-term goals. But when you track your net worth monthly, everything changes. Patterns become visible. Progress becomes measurable. Decisions become calmer. Your net worth is the real scoreboard, not the color of your stock app today. And once you stop letting daily fluctuations control you, you're finally ready to understand one of the most expensive beginner blind spots: the hidden costs that slowly drain your wealth. Most beginners lose more to invisible costs than to bad decisions. They pay brokerage fees without noticing, buy funds with high expense ratios, ignore the tax consequences of selling too often, and underestimate how much unnecessary trading drains their returns. The market builds wealth slowly. Fees destroy it quietly. Taxes reduce it predictably. And over a decade, these small leaks can cost you thousands. Wealth isn't just about what you earn. It's about what you get to keep. When you understand how fees and taxes work, you stop leaving money behind and start letting more of your returns stay where they belong, in your future. And once you protect yourself from hidden costs, you're ready for one of the hardest but most rewarding rules in long-term investing: holding longer than feels comfortable. Here's a question that reveals your true investing maturity. When the market scares you, do you stay committed or do you run? The market will test you. It will drop suddenly, rise unexpectedly, and move in ways that make no sense at all. Beginners panic because they believe every dip is danger. Experienced investors understand that dips are normal and often necessary. Long-term holding is the engine of wealth. Every cycle you endure strengthens your foundation. Every downturn you survive becomes a chapter in your growth. And now, we reach the final rule, the rule that shapes every decision, every habit, and every outcome in your financial life. Most beginners obsess over finding the best stocks, the best portfolio, or the best timing. But the truth is almost ironic. You can give 10 people the same strategy and they'll all get different results. Why? Because money is emotional. Fear, impatience, self-doubt, shame, and comparison shape financial outcomes more than charts, formulas, or predictions ever will. The answer is simple. Your behavior is the real strategy. When you build emotional stability, when you stay consistent instead of reactive, when you trust time instead of panic, you finally break the cycle that keeps beginners stuck. Master your mind and your money will follow. And now that you've seen all 12 rules, let's pull everything together. Because the real transformation happens when these ideas stop being tips and start becoming your foundation. So let me ask you one final question. What would your financial life look like if you actually lived by these 12 rules, not just heard them? Because when you step back, the truth becomes clear. Investing isn't about finding the perfect stock or predicting the perfect moment. It's about creating habits strong enough to steady you when the world feels uncertain. Clarity replaces guessing. Consistency replaces motivation. Simplicity replaces overwhelm. Patience replaces panic. These rules aren't just strategies, they're anchors. And when you apply them, even imperfectly, your future stops feeling chaotic and starts feeling possible. And with that foundation in place, let's close today with a reminder that ties it all together. Your financial freedom is built quietly, calmly, and over time. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. Always assess your risk tolerance and investment goals before allocating your capital. If you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. Financial freedom isn't built in dramatic moments. It's built quietly, in the habits you repeat, the rules you follow, and the choices you make when no one's watching. Thank you for spending this time with me. Stay consistent, stay patient, and as always, stay winning. See you in the next one, Money Magician.